If you sold your home this year, or if you're planning to sell in 2026, there is something very important you need to understand before you do. Something that most seniors do not find out about until it is too late. Something that can quietly reduce your GIS payments, or even trigger a clawback on your OAS for an entire year, sometimes longer. And the frustrating part is that the money from the sale might already be spent or sitting in the bank, and you have no idea that your government benefits are about to take a hit. This is not a scare tactic. This is a real rule. It comes directly from the Government of Canada. And today, we are going to walk through it together in plain English, so that you understand exactly what is happening, why it happens, and what you can do about it. If you receive GIS, which is the Guaranteed Income Supplement, or if you receive OAS, which is Old Age Security, and you are planning to sell any property in 2026, this video is for you. Stay with me through the whole thing, because the second half covers a very important tool that many seniors have never heard of, and it could save you hundreds or even thousands of dollars. Let us start with the basics, so we are all on the same page. When most seniors talk about selling their home, they are usually talking about the house they have lived in for years, maybe decades, the house they raised their family in. And naturally, many people assume that because they lived there, the money they receive from the sale is simply their own money coming back to them. Not income, just the return of something they already owned. And in many cases, from a tax perspective, they are right. Under Canadian tax law, if you sell a property that qualifies as your principal residence, the capital gain from that sale is generally exempt from income tax. That is called the principal residence exemption, and it is a significant protection that the Canada Revenue Agency, the CRA, provides to Canadians. But here is where it gets complicated for seniors who receive government benefits. Even if your home sale is tax-free because of the principal residence exemption, there are situations where the proceeds of the sale or the circumstances around the sale can still affect your benefit calculations. And if you are selling a second property, a cottage, a rental property, or a home that was partially used for business, the rules change significantly, and the impact on your GIS and OAS can be very real. Let us go through this carefully. First, let us talk about the Guaranteed Income Supplement, or GIS. This is a monthly, tax-free payment that goes to low-income seniors who are already receiving OAS. It is designed specifically for people who need extra financial support, and the amount you receive every month is determined by your income from the previous year. That word, previous year, is important. Your GIS payments are not based on what you earn right now, in 2026. They are based on what the government sees on your 2025 tax return, and your 2026 GIS payments, which begin in July 2026 after your 2025 return is processed, are calculated using that 2025 income. So here is the situation. Let us say Margaret has been receiving GIS for 3 years. She receives it because her income has been low. She lives on CPP and OAS and a small pension. In 2025, she decides to sell a cottage she has owned since the 80s. She bought it for $60,000. She sells it for $320,000. That is a capital gain of $260,000. Because the cottage is not her principal residence, the principal residence exemption does not apply. Under Canadian tax law, capital gains are included in your taxable income. Currently, Under the rules in effect for the 2025 tax year, a portion of that capital gain becomes part of her net income on line 23,600 of her tax return. Now, here is what happens. When the government calculates Margaret's GIS eligibility for the period starting July 2026, they look at her 2025 net income. That net income is now much higher than it used to be because of the cottage sale. Even though that money was a one-time event, even though Margaret is not going to sell a cottage every year, the GIS calculation does not automatically know that. It sees income, high income, and it reduces or eliminates her GIS accordingly. For Margaret, this could mean losing her GIS payments entirely for a full year. Starting in July 2026 and running through June 2027, her GIS could be zero or dramatically reduced based on that one transaction. That is a real and painful impact, and it happens to more seniors than you might think. Now let us talk about OAS and the clawback rule, which is officially called the OAS recovery tax. Old Age Security is a monthly pension that most Canadians over the age of 65 receive. Unlike GIS, OAS is not strictly a low-income benefit. Most seniors get it regardless of their income, up to a point. But if your net income for the year exceeds a certain threshold, the government begins to recover or claw back some or all of your OAS payments. For the 2025 tax year, that threshold is approximately $90,000 in net income. The exact number is adjusted each year for inflation, but the mechanism stays the same. If you earn above that threshold, for every dollar above it, 15 cents of your OAS is recovered through your tax return. So going back to Margaret, if her net income for 2025 is significantly above that threshold because of the cottage sale, she will not only lose her GIS, she may also face an OAS clawback on her 2025 return. That means she could owe money back to the government when she files, or she could see her OAS reduced for the following benefit year. 2 hits at once. GIS gone, OAS reduced, all because of one property sale. Now, what about selling your actual home, your principal residence? This is where many seniors get confused, and understandably so. If you sell the home you have been living in as your main residence, the capital gain is generally protected by the principal residence exemption. You do not pay income tax on that gain, and because it is exempt from income tax, it generally does not count toward your net income for GIS or OAS purposes in the traditional sense. However, and this is very important, you are still required to report the sale on your tax return. Since 2016, the CRA requires Canadians to report all principal residence sales, even if no tax is owed. Failing to report it can cause problems later and may result in penalties. Now, there are some exceptions. If you rented part of your home, or if you used part of your home for business and claimed expenses for it, the principal residence exemption may only apply to part of the gain. The portion that was used for income-producing purposes may still be taxable. So if you have been renting out your basement, for example, or running a business from your home and writing off a portion of your expenses, speak with a tax professional before you sell. The numbers can get complicated quickly. For most seniors who simply lived in their home, the principal residence sale should not trigger a GIS reduction or an OAS clawback, but you need to report it properly. And if the CRA has any questions about the exemption, it is important to have your documentation in order. Let us look at another example to make this concrete. George and Helen are a couple. George is 72. Helen is 70. They both receive OAS and GIS. They have lived in their home for 35 years. In 2026, they decide to downsize. They sell their house for $800,000. They bought it for $90,000. That is a massive gain on paper, more than $700,000. But because this is their principal residence, the entire gain qualifies for the exemption. They report the sale properly on their 2026 tax return. Their net income does not include the capital gain. Their GIS payments are not affected. Their OAS is not clawed back. The sale money goes into the bank, and they move into a smaller home or a retirement community without their benefits being touched. That is how it works when the exemption applies correctly. Now let us change the example slightly. Same couple, but George and Helen also own a small rental property they bought in the 90s. In 2026, they sell the rental property for $400,000. They bought it for $100,000. That is a $300,000 capital gain. The rental property was never their principal residence, so the exemption does not apply. A portion of that gain is included in their net income for 2026. When the government processes their 2026 tax return in 2027, their GIS for the July 2027 to June 2028 period is recalculated based on that higher income. Both their GIS payments could be significantly reduced or eliminated for that year. This is real. This is the rule. And understanding it before you sell is far better than finding out afterward. So now we come to the most important part of today's video, the tool that many seniors have never heard about. It is called the Estimated Income Option, and it is offered by Service Canada, specifically for situations like this. Here is the problem it solves. GIS is always based on the previous year's income. But if your income drops significantly in the current year, you are still being paid GIS based on last year's high income, which means you are getting less than you should. Or worse, you are getting no GIS at all, even though your current year income is low again. Service Canada understands that some seniors experience one-time income events, a property sale, an inheritance, a pension payout, something that spikes income in a single year but is not representative of how they normally live. In these cases, seniors can apply to have their GIS calculated based on their current year's estimated income rather than the previous year's actual income. This is done by completing an application with Service Canada and providing an estimate of what your income will be for the current year. For example, going back to Margaret, she sold her cottage in 2025, and her 2025 income was very high. As a result, her GIS was eliminated starting in July 2026. But in 2026, she has no cottage to sell. Her income is back to normal. She is living on CPP and OAS just like before. Margaret can apply to Service Canada and say, "My 2026 income is going to be much lower than my 2025 income because the cottage sale was a one-time event." She provides her estimated 2026 income. Service Canada reviews the request and may reinstate her GIS based on that lower estimate. When she files her actual 2026 tax return in the spring of 2027, the government will check her estimate against her real income and make any necessary adjustments. This is not a loophole. This is an official program offered by the Government of Canada. It exists precisely for situations where a one-time income event would otherwise cause a senior to lose benefits they genuinely need. To apply, you can contact Service Canada directly by phone, visit a Service Canada centre in person, or apply through your My Service Canada account online if you have one set up. The process requires you to declare your estimated income for the year, and it is important to be as accurate as possible because if you underestimate, you may need to repay part of your GIS later. Let us also be clear about what not to do. Do not ignore the situation and hope it resolves itself. If you sold a non-principal residence property in 2025 and you have not yet thought about how it will affect your 2026 GIS, this is the time to address it. Do not assume that because the money is sitting in your bank account and not being used, it does not count as income. The capital gain was recognized in the year of the sale, regardless of what you do with the money afterward. Do not wait until your GIS stops before asking questions. If you know a property sale is coming or has already happened, reach out to Service Canada proactively. Ask them about the estimated income option. Ask them how your GIS will be recalculated and when. And do not confuse net income with what you actually received in your bank. Net income on your tax return is a calculated number that includes things like capital gains, pension income, CPP, OAS, and other amounts. It is not the same as your bank balance, and it is not the same as your take-home pay. When you are talking to Service Canada or checking your eligibility for GIS, they are working from line 23600 of your tax return. That is the number that matters. There is also a timing element to understand. GIS is recalculated every July. That recalculation is based on your previous year's tax return. So if something significant happens in your 2025 tax year, you will see the impact in your GIS starting in July 2026, and that change will remain in effect until June 2027, when the next recalculation happens based on your 2026 tax return. This means that even a one-year spike in income can affect your benefits for what feels like a very long time. You file in April 2026. The government processes your 2025 return, and your new GIS amount kicks in July 2026. You live with that reduced amount until July 2027. That is why applying for the estimated income option as early as possible in 2026 makes sense if you are in this situation. For OAS, the clawback is handled differently. If your income exceeds the threshold in a given year, you may owe OAS recovery tax when you file your return. The CRA may also start reducing your monthly OAS payments the following year if they project your income will remain high. But if it was truly a one-time event and your income returns to normal, your OAS payments will return to normal as well once your next tax return is filed and processed. Here is the calm summary of everything we covered today. If you are selling your principal residence in 2026 and you have lived in it as your main home, the capital gain is generally exempt from tax. Your GIS and OAS should not be affected, as long as you report the sale properly on your tax return. If you are selling a second property, a cottage, a rental, or any property that does not qualify for the full principal residence exemption, the capital gain is taxable. That gain becomes part of your net income. If it pushes your income high enough, your GIS could be reduced or eliminated for the following benefit year. And if it pushes your net income above the OAS clawback threshold, you may owe OAS recovery tax or see your OAS reduced. If this has already happened, or if you know it is coming, contact Service Canada and ask about the estimated income option. This allows your GIS to be recalculated based on your current year's income rather than the previous year's spike. Always report your property sale to the CRA on your tax return, even if no tax is owed, because failing to report it can cause complications later. Check your My Service Canada account regularly to see your current benefit amounts and any letters or notices sent to you. If you do not have an account set up, you can call Service Canada at 1-800-277-9914 to speak with someone directly. And if you are unsure whether your home sale will affect your benefits, please speak with a tax professional or an accountant who understands senior benefits before the sale closes. Getting clarity beforehand is always better than trying to undo the impact afterward. Before we close, I want to ask you something. Are you planning to sell a property in 2026, or have you already sold one recently? Have you thought about how it might affect your GIS or OAS? Let me know in the comments below. You can simply say yes, I am selling soon, or I already sold and I had no idea this could be an issue. Your questions help other seniors watching this video understand they are not alone, and your experiences help me know what topics to cover next. If this video helped you today, please consider subscribing to Retirement Path Canada. We do not sell anything here. We do not promote investments or financial products. We simply explain Canadian government benefits in plain English so that you can make informed decisions about your own retirement. New videos are posted regularly on CPP, OAS, GIS, and related topics that matter to Canadians in or near retirement. Thank you for watching. Take care of yourself and take care of each other.